Hey guys, David from the Trade Study here. Gonna do a quick video, part two, I guess you could say, on the Income Estimator Tool provided by TD Ameritrade. In the first video, I talked about the Income Estimator Tool, how it works, some of the different features it has here, the dividend yield, dividend per share, the frequency, whether it's paid out quarterly, monthly, a lot of good information that's provided here on this tool. What I wanted to do with this video specifically is show you guys how I use the Income Estimator Tool and maybe how you can utilize it as well to get your portfolio started and going. Now, I'm not saying, hey, go get a dividend portfolio. This is something that you'll have to go talk to your financial advisor about. But what I want to show you is that I have various investments, and of course, I like to have dividends being paid out to me. It's kind of like the cherry on top of the cake. It's the toppings, it's the finish, it's the icing. And I love that I don't have to really do anything except purchase these shares that say I have ownership in the company, and I get paid a portion of their earnings for holding on to their shares. It's a good deal. So, with that being said, I'm going to do an example here with 3 investments. Before we do these 3 investments, you need to find out how much money you're bringing in on your earned income, on your paycheck. So, once you establish that, then you need to decide a budget. That budget needs to be making sure that you're able to pay your bills, your rent, all that good stuff, and then whatever savings you have left off to the side, and then extra money you have left off to the side, you are then going to decide, hey, I can put maybe, for this example, let's do $1,200. $1,200 per month from my earned income is going to go into this income estimator dividend portfolio where I'm going to be collecting an extra income over time. The beauty of this is that it's going to grow with compounding over time, and you probably have heard of that phrase before, compound interest. It's pretty much using the power of dividends and then taking those dividends and market gains to be reinvested into your stock holdings, which then further multiply your stock holdings, therefore multiplying the dividend pile or the dividend shares that you're going to be receiving. Now, for this example, we'll use $1,200 per month. $1,200. So you're going to be looking at here. I chose AT&T. I wanted exposure to telecommunications. And then I chose a pharmaceutical company because I did want some healthcare exposure. And I wanted realty income to have exposure to real estate and the consumer market through their different tenants that they have. So like AMC, Home Depot, a bunch of others. So you could go on their website and learn about that information. Again, this is an investment recommendation or suggestion. This is just for educational purposes to show you guys the power of the Income Estimator tool and how I use it. So now this is going to be month 1. Month 1, I am going to be putting about 13 shares of AT&T and then 3 shares of Abivai and then 6 shares of O. If you notice, they are all going to come out to close enough to $400 each. I don't want to exceed my budget. So the total for this month came out to $1,115 with 20 cents. That is going to yield me about $59.56 over the year. This is a good start. It may not seem like a lot, but we are generating about an average yield of 5.3%. You are not going to get that on a savings account or any other of these, CDs. Those things are not providing great returns today like they were before. So, and on top of that, you're collecting dividend and any capital appreciation from holding those stocks. You can recognize those capital gains as well. But the purpose of this video is going to be showing you over the long run the power of a dividend income portfolio, how it compounds over time. So with month 1 being done, let's do month 2. 13 times 2, right? I'm going to purchase another 13 shares. I'm going to have 26 shares of AT&T. I'm going to add another 3 shares to my pile of Abivai. And then I'm going to add another 6 shares to O Realty Income, pretty much doubling up my investments. So this number of total market value is going to come out to about close to 2,000. If we hit calculate income here, there we go, 22.30 with 40 cents. I am now gaining $119.12 as my estimated annual income, and this is without any assumption of the stock price moving up. We are not looking at the stock price here. We are looking at just estimated annual income. And then so the dividend is going to be providing the same yield here, and this is just a model that's being based on the dividends being paid from these companies without considering the stock price moving up or down. Now, as we keep on doing this, you're going to notice that this estimated annual income keeps going up, right? So what if I buy, let's say I do this 1, 2, 3 months, right? And at the end of the year, how is this going to look like? I'll pull out the calculator right over here. So if we were gaining $59.56 and we did this for 12 months, we would end up at about $714.72 paid out in dividends over the year. That is a pretty good deal. How does this look? Let's put in the numbers right now to see how I came up with this calculation. So Abivai, right? We had 3 shares. Over 12 months, it's going to be 36, right? 36. We had 6 shares of O Realty. So 6 times 12, 72. And then the AT&T, we had 13 times 12. It's going to be 156. Let's see how this looks. It should be more or less around the same number. $714.72 of estimated annual income in the form of dividend is going to be paid to you over the year. And yeah, that was let me see if I can pull up the history here. Yeah, 714 was 72. Awesome. So this is all from 1 year. Now we get to year 2, right? How would this work? You just do 714, 72 times 2. You should end up with something around $14.29 with 44 cents. And as you are putting this money in, maybe using the DCA model, dollar cost averaging, that is simple and effective. I love that strategy. Not trying to time the market. You just set it, forget it. You do your 9 to 5 or your night shift, and you are baking this beautiful side of income that you can use to help you out in the future. With that being said now, how does this look on a larger scale when we, let's say, 10 years, 20 years out, right? Well, I got an Excel spreadsheet right here to help you out. And if you look, you have year 1, right? We just did that, $714.72. Year 2, you're going to be at $14.29. So how much are you going to be getting paid in just dividends by year 5? $3,500, close to $3,600. That's a pretty good deal for not having to worry about anything. You're getting paid that much, 5% on your, or what is it, 5.4% yield on our investment. Now you get to year 10. And you are already getting paid about $6,400, which you could decide whether you want to reinvest that with the dividend. Remember, this is not even considering dividend reinvestment or DRIP. This is just looking at the amount that we're putting in every month. So these numbers can actually be even bigger and further compounded. By the time you get to year 20 and being consistent and following your plan off of just these 3 investments, you're looking at about $14,294 with 40 cents, not considering the dividend reinvestment as well compounded on top of that. So you would probably be up a couple extra more thousand on top of that. That is incredible. That is the power of compounding and dividends and being invested and paying you. And although you'll get a question that says, hey, when do I upgrade to 4 or 5 holdings? And that's a good question. Ideally, you want to make sure you're buying into companies that are trading at a discount, or aka at attractive value. You want to make sure that they're trading below their their value using fundamental analysis. If you don't know what that means and you don't want to break your head over that, use DCA, dollar cost averaging. Very simple, very effective. Doesn't have to worry about timing the market. Again, you want to make sure you're with companies that you know that are going to be around for 5-10 years out. We always talk about that over at the study. Very important. You want to make sure you're with companies that are reputable, well protected, that are going to stay around. And that is all it is to the income estimator tool. And this is exactly how I started using it about 5-6 years ago, and still building it up as my little side portfolio income. And then on the other side, I have my growth investments and other investments in different asset classes. So guys, I hope you enjoyed this video. I wanted to put this together to further explain how I use this tool. If you have questions about how this tool works, check out the first video with the Income Estimator Tool that I posted. If you want to find out more information, visit www.thetradestudy.com. You can shoot me an email, david@thetradestudy, to find out if you have any questions. I got answers. I'm glad to help you out. Have a good one. Like the video, subscribe. I'll see you in the next one.